Let's break down the report with Chris Marinac, the head of research at Janney Montgomery Scott. Chris, always great to speak with you.
Thank you.
So it wasn't just a severe recession that was tested, but also a 40% decline in commercial real estate values. And so I'm wondering if you think that this test really gives you sort of the green light here.
Well, it does give a green light that the banks are secure and the banks have plenty of cash flow to cover the issues that are out there. And cash flow, or PP&R, is really the key for the industry, because as you look at the next 2.5, 3 years, whatever issues we have, I think the weather will change. We will have colder weather, snowstorms that will occur on credit, but banks can handle it with the both capital as well as the operating earnings, or PP&R, that they have. So it just confirms what we thought was out there. From an investor standpoint, the stocks are really cheap. We've seen expectations for earnings and cash flow come down about 15% at most year to date, and the stocks are down 30%. So I think it's been an overreaction, several months in the making now, and it's time to see some reversal. So we're in a trading range, but I think we can have better valuations ahead for these stocks.
You say the stocks, and of course that's a big swath of different kinds of banks, Chris. So which ones are the best values right now in your view?
Well, the regional banks have the best liquidity, and they have been the area of most concern. So if you look at a Fifth Third Bank, a Wintrust Bank, we like PacWest as a comeback. The company is not failed and is now selling assets and improving their position significantly, and that's a comeback story. We still like stories of a mid-cap name like an Ocean First, OCFC, a Ameris, ABCB, and then there are many others in that mid-cap and even large regional bank arena. Most of these companies are profitable. They may have lower expectations because of net interest margins, which is, I think, the key pain point for companies right now. But overall, they're still very healthy, which the stress test simply just reinforced. And I think as that gets applied to other banks on down the size chain, you will see that the same results occur. They all pass the stress test that happened for those companies.
Chris, it's Karen. So let me ask you, where we have sort of a tale of two cities in the banking world. We've got, the JP Morgans of the world and then the regionals. I would think we have to see meaningful consolidation to be able to leverage the balance sheet, leverage the technology costs. How quickly do you think we'll see that landscape change and fewer banks?
I think it'll take 3 or 4 years, Karen. I really think that the inside of the Fed, particularly the bowels of the examiners who really control how fast deals get approved, they're not in a hurry to approve mergers. I mean, we may see changes from Treasury and Fed in terms of talking about adopting consolidation, but the real folks who approve deals are just not in a hurry to do them. So I think it's going to take a couple of years for that to happen. But along the way, the banks are going to still make money. I think you'll see them recognize the problems. This quarter coming up will have a lot of reserve building, extra provision expense. That's probably why the estimates have to come down a little bit, but the stocks really have reflected that for several weeks.
Chris, we're just putting up the criteria for the stress tests in terms of what the hurdles the banks have to clear. And I'm wondering, and maybe this is too technical, I'm just curious how these tests are implemented. Is it today you have this balance sheet, we're going to enact these, this change in your world for banks, and that's it? Or is there a time built in for the banks to adjust? Sure. Is it an overnight kind of thing? Employment piece of 10% tomorrow?
Sure. It's a 9-quarter process where you change the economic scenarios. You have both stock prices and real estate prices fall about 40%, and then you have 9 quarters to kind of implement those changes and sort of accept, if you will, in terms of writing off the problems that you have. So that's the issue. It's not a shock, which of course did happen in real life in March when you had a shock to the system with the 2 and then 3 banks that failed. And perhaps adding a shock analysis would be better commentary from the Fed, and we may get there eventually. But that's not what this is. And of course, the other flaw to your question, I think, is also that interest rates fall in this scenario, which really unlocks a lot of the unrealized losses that are in bank securities portfolios. So that's a key reason why the stress test does have its flaws. But the time frame is a 9-quarter look.
Right. And so if the Fed say, hey, Chris, what do you want to change about the stress test? What other criteria do you want to put in? Would it be that it should be less than 9 quarters? I mean, we've seen interest rates move very quickly. The volatility in interest rates is much greater than equities. That seems to be a major flaw in this, particularly coming off of the bank crisis we saw in March.
Well, that's correct. I mean, you certainly could make it much more of a 6-month or a 3-month process to see how banks adapt to a sudden shift in interest rates. Of course, we've seen that over about 5 quarters with what the Fed's done from March to now almost July. I think from an earned standpoint of how long it takes companies to recognize credit problems, it does take longer than a few quarters. And again, I think a 2 to 3 year time frame is fine for that. But the shock analysis really needs to be a shorter time. So I think that's a great point.